Well, the markets rose sharply today, gaining back more than half of Monday's big losses. The Dow was up 157 points when all was said and done, ending the session at 14,756. NASDAQ up 48. The S&P 500 added 22 points. Stocks got a big boost from a round of solid economic data reports and stronger than expected earnings before the bell from Dow components Coca-Cola and Johnson & Johnson. As for that data, inflation is still in check. Consumer prices fell more than expected last month, driven lower by a 4% decline in prices at the gas pump. Also helping, industrial production was higher than forecast in March, with U.S. automakers churning out more new cars and trucks, and utilities generating more heat to combat a nationwide cold snap that we all suffered from last month. And there was more good news in housing. Construction of new homes shot up by 7% in March, enough to reach an adjusted annual rate of 1 million housing units for the month, something we have not seen in 5 years.
Well, Bill, that jump in new home building that you just talked about helped send shares of the nation's biggest home builders higher today. Pulte Homes rose more than 4%, Ryland up 3.5%, D.R. Horton, Toll Brothers, and Hovnanian all seeing gains. Now, much of that surge in construction was not single-family homes, however, but multifamily rental apartments. It's a sector that's been growing rapidly over the past few years, and now there's concern about a backlash in all those rental units that are hitting the market all at once. Diana Olick explains.
As the market for single-family homes recovers, a curious contradiction swings overhead. Cranes high above construction sites of multifamily rental apartment buildings. Thousands of new units are going up, just as demand for rental apartments could soon be coming down. Multifamily starts rose 27% month to month in March and are up 82% from a year ago, running at an annualized pace of 392,000. Compare that to the 10-year historical average of 238,000.
A year from now, will we be seeing much stronger headwinds for the space? Potentially. The supply trajectory clearly is changing. Mortgage credit is clearly loosening. If we stay in the current pathway, I would expect that demand will be diminished somewhat.
The numbers don't show it yet. Apartment vacancies fell in the first quarter of this year to 4.2% nationally from 5% a year ago. That pushed rents higher by 3%. Despite sluggish job and wage growth, renters are still willing to pay these higher costs. But the question is, for how long, especially as confidence comes back to single family. It takes about 2 to 3 years to put up an apartment building, so with all these new starts over the past couple of years, we're about to see a big surge in supply. And that just adds to investor fears already weighing on apartment REITs.
What we've seen in the multifamily REIT space for the last couple of years, certainly last year and this year, has been relative underperformance to the rest of the REIT market. A big part of that has been fear around supply. There's a bigger concern around rental growth as well. Supply ties into that. But real estate is still all about location, and developers in prime urban areas claim the market is hot but not overheated.
No, we're not concerned about any of that. I think the market is ripe for us to take advantage of locations that we are.
More than 100,000 new apartment units are set to open in the latter half of this year, with an even stronger surge set for 2014. For Nightly Business Report, I'm Diana Olick in Washington.